world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Sean Hanafin. Sean is the Group President of Greensill, a modern supply chain finance provider that's raised an astonishing $1.5 billion in equity this year alone. Backed by General Atlantic and Softbank, Greensill is aiming to quickly scale its technology-driven supply chain finance offering across the largest markets in the world. On top of that, the company is looking to leverage an approach similar to its B2B financing model to unlock daily salary access for public and private sector employees, ending payday lending forever. With a banking license in Germany, a team of highly experienced senior bankers, and aspirations to reimagine the multi-hundred billion-dollar global supply chain finance market, it's safe to say this is no ordinary fintech startup. For all of our past episodes and to sign up for our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Sean Hanafin. Sean Hanafin, welcome to Rebank.
Thank you very much, Will. Great to be here.
Yeah, thanks for taking the time. We're sitting in your beautiful Covent Garden area offices overlooking the Strand. This is really, really fantastic and a nice sunny day, or at least sunny morning here in London.
No, well, it's great to be here. For me personally as well, I was involved a little bit at the start of the Greensill journey 8 years ago. There was no office, certainly not an office in Covent Garden. There were 5 guys. I was at the time actually running a family office. So I was sort of helping Lex in the very early days when he was setting this business up. I think my observation, having been back now 6 months, I'm the group president of the firm, is that with 500 people here today, the one thing that hasn't changed is the entrepreneurial spirit of the firm. And I think that's probably the core value that we need to maintain and preserve as we continue to grow. I mean, we're 500 employees today, as I said. This time next year will be something close to 1,000. And I think if we can preserve that culture, we'll continue to grow as we have done over the last 8 years. Wow.
Well, it sounds like you got your work cut out for you. I imagine a lot of that will be your responsibility.
A little bit of it will be, yeah. And I think one of the reasons actually that I was asked to come back into the firm was really to help put the structure in place. And I use the word structure deliberately because I think if we start creating layers and bureaucracy, we sort of become the type of firm that 500 of us left for a very good reason. We want to make sure that the innovation stays at the core of this business, even though we have huge plans to scale.
Yeah. Well, 500 employees left, yourself included, I guess, and I want to get into that. So maybe just to kick off, quick high level description of Greensill's business and a little bit of the backstory.
Sure. Well, as I say, it was set up 8 years ago by Lex Greensill with a group of 4 or 5 people who'd come out of Citigroup. Citi has historically been the largest provider of supply chain finance globally. I use the word historically because things are changing. The market is being fast disrupted. But the main proposition, I would say, of Greensill is actually about taking supply chain finance to small and medium-sized companies who actually have much greater need for the concept. So for those of your listeners who perhaps aren't familiar with what supply chain finance is, it's about allowing the suppliers of a large, normally multinational corporate to avail themselves of the funding cost, the halo, if you like, that large corporate provides from the quality of the credit. And banks will typically look at the top end of a large multinational supply chain, and they'll offer this service to, let's say the 20%. It's actually the 20% that probably, I would argue, don't really need it or don't need it very much. The 80% in the tail are the small guys, the mum and pup shops, for example, who really do struggle for finance. And if if they can't access finance through supply chain finance, will probably go to their bank and be borrowing at pretty significant rates of interest. And it might be worth, just sort of saying at this point, I think that one of the reasons why Lex got into the whole concept of supply chain finance is because he actually grew up on a farm in Australia where, despite having very significant contracts with the large supermarkets, the family were waiting sort of 6+ months to be paid. And their alternative funding option was to go to the bank and pay an egregious amount of interest. So he sort of figured out pretty quickly that actually he had a contract that could be monetized, and that effectively was the genesis of supply chain finance. As I say, though, unless you can take that out to the little guys, there's really no social utility in the product. And so I think it was a real passion of his. It was a business model that was not something that the banks really were able to capture. And that's not a criticism, it's a function of the lack of technology around onboarding and around knowing your customer, KYC, which meant that if you wanted to onboard an additional supplier, it would probably take you 2 weeks to do so because it was a very paper-intensive process. So the only way this works is if you can apply technology to that process.
Love it. Okay, so to summarize then, traditionally you had large suppliers of big supermarket chains and other multinationals who would sell their product to the supermarket chain, would get some sort of credit. It was going to be paid in 90 days or 120 days or whatever it was. They would sit there, kind of burn working capital while they waited to get paid. The solution was for the more structured, larger suppliers to then go to a bank, pledge that credit in exchange for immediate payment, give up a bit of that invoice when it was going to be paid for the pleasure, but help them effectively fund their business and keep going. The 80% long tail didn't have access to that same service.
Correct.
And were forced to pay high interest rates to source the working capital they needed.
That's exactly right.
So what you mentioned technology being the solution, not surprising given the world that I think a lot of us listening, a lot of us close to Rebank come from. But tell me specifically about the way that Greensill is addressing this problem.
Sure. So I think it's actually, without getting too much into the weeds, because a lot of this we'd consider IP, it's actually a mindset shift. I've come out of a big bank, and I'm certainly not going to be critical of big banks. I enjoyed my time in them very much, but there is a frustration for a lot of the employees in those types of firms because they've had to react to the financial crisis and the huge fines that a whole load of those institutions have taken, and the natural response to that is probably to put in place more regulation, more checks and balances than are actually required. And what that does ultimately is stifle innovation. Now, our view is that we absolutely need to be, making sure we're clearing the bar from a regulatory perspective with some distance. But it also allows us, because we're coming from the point of view right now that we're a young company, to build things in the right way rather than to react and have to undo things that perhaps weren't, as they should have been. So we own a bank in Germany. We're regulated fully by BaFin, the German regulator. And I think that's really important as well, because from a credibility perspective, it means we have skin in the game for each and every transaction that we're placing into the market. And we place those transactions through multiple channels to either institutional investors, other banks, or a number of funds which we've set up with asset managers. So we've got the credibility of a bank, I would argue, but we have a blank piece of paper, or we did have a blank piece of paper to go and design the right sort of business model from an efficiency perspective, from a governance and control perspective, and from a regulatory perspective. So technology sits at the heart of that. We talked about the KYC process, but it also sits at the heart of how we make risk decisions. So we won't, for example, rely purely on the financial statements of a small company. We'll clearly look at them. We'll want to see all the information we can to make a decision, but we'll also look at data across 3, 4, 5, even longer periods of time. And we'll take a view, and I'll give you an example. And it was a frustration I had when I was sitting in a big bank, that I would look at the supply chain of one of the world's largest FMCG companies, and I would see a supplier who, on paper, had financial leverage, at a level which a bank wouldn't be comfortable with. In terms of the scale, it wasn't significant enough to be exciting. And frankly, as a result of that, the credit rating of that company was not investment grade. And so it's very difficult for a risk officer in a big bank to get to yes. And even if they do, in terms of the returns, given Basel III and Basel IV, and the regulatory capital requirements that have been put on the large banks, very, very difficult to make the right returns. So in short, it's just too hard for a big bank to get to yes for something like that. That leaves a huge opportunity for us and others in terms of almost an unbanked part of the corporate landscape. And so we use data, frankly, to analyze those types of opportunities and those types of situations, because whilst that small client might not have an investment grade credit rating, it could very well be a strategic supplier to that large FMCG company. And in the case that I'm referring to, has been for 20 years. The data will tell you that they've supplied at 99% plus levels in terms of contract obligations. And it will also tell you that they've been paid at 99% plus in terms of the contract being fulfilled and settled. And so we can make decisions based on a combination of that data as well as the traditional methods that banks will use. And I would argue that the more information, the more data you can access and analyze, the better your risk decision will be.
To what extent are you then offering that credit on balance sheet versus kind of originating or facilitating capital provision by other parties in the market?
Sure, a really good question, because if you think about it, if we're doing it on balance sheet, all we're doing is round tripping this, and we've got the same sort of regulatory capital issues ultimately with Basel III and so forth as any other financial institution or any other bank would have. So the answer is, as I mentioned, we like to have some skin in the game, because I think it demonstrates credibility that what we're trying to sell to the market, we believe in ourselves. But what we're doing, and this is another sort of key differentiator, I think, in terms of Greensill's model versus a traditional bank, is taking those transactions and those assets out to funds, out to institutional investors, and actually they're looking at this in a very different way from banks. And indeed, banks are looking at it in a very different way than they were 10 years ago. What's changed is that regulatory capital requirements have doubled, and therefore returns have halved. And you don't have to be a scientist or a mathematician to figure out that the model is struggling in terms of covering its cost of equity now for the big banks.
So your model, I think, has attracted the attention of a number of people in the market, including some deep-pocketed investors. I think you've raised something crazy like $1.5 billion in equity just this year, I think, to help scale the business. Can you talk a bit about the institutional support that you guys have found?
Sure, yeah, very happy to. You're right. We've raised a significant amount of capital in round numbers, actually approaching about 1.75 across two private equity houses, General Atlantic and Softbank. Both are, fantastic supporters of the business model and have board representation. And, we're delighted to be partnering with them for a number of reasons, actually. And it's not just about the capital, but I think they demonstrate credibility. I mean, let's be frank. I mean, we're a disruptor competing against big banks who have been around for 150 plus years in many cases, and some 300 plus years. And when you're breaking into the corporate landscape, it's the old principle: if you hire IBM, you don't get fired. And from a corporate treasurer's perspective, I think by nature, many are quite rightly very considerate about the risk that they take, including who they work with. So I think for us, it was not just about the capital; it was about a credibility badge. And I think also when you look at it in the context of the fintech universe, we were punching through a glass ceiling. And you'll probably be more familiar, Will, with Reid Hoffman's book Blitzscaling than I am, but I've read it with interest. And one of the things that really struck me was that if you are able to create a significant market share and attract financial capital as well as human capital, it creates a virtuous circle. And I think in the 6 months I've been here, we've seen a number of really big hires, really high quality hires that frankly would have been tough to attract into a really early stage company. So we're only 8 years old, but I would sort of segment that into two halves. The first 4 years were the really hard yards where people were building capability, developing a business model, trying to develop a team, build a franchise that we could take out to market. And then the last 3 or 4 years where actually we've been growing 100% year on year and continue to do so actually. And the numbers clearly get bigger and bigger, so it's tougher and tougher to do that. But we came out of a board meeting yesterday, and I think the whole board has great confidence, including our institutional investors, that we'll continue to grow at that rate. One of the things that we won't sacrifice is profitability. I think that's really critical to building a sustainable business. We're debt free. So I guess the question sort of begs itself, so why raise the capital other than the credibility badge? There's 2 reasons. One is that SoftBank in particular is very focused on making sure there's a connection between the Vision Fund portfolio companies. And so it's been tremendous in terms of opening up access to other businesses and the entities that have invested into the Vision Fund. As a banker for many years, I've put large checks of hundreds of millions of dollars on the table in order to get an annual hour with the CFO of a big multinational. When you're actually connected through equity, it's a little bit more like a blood connection rather than water, and you're connected at the top of the house. And that doesn't mean the outcome is any different. It just means you've got the right level of access to have that conversation. So I think that's been really critical for us. And then the other is a point which we touched on briefly, which is that frankly it's a credibility leap for us and gives us deep pockets now. We're highly liquid, and the intention is that we're going to move at speed into a number of key markets: China, India, Brazil, Middle East is a big opportunity for us as well as actually extending the concept of supply chain finance from the B2B space into the B2C space, i.e. we're taking the concept of early payment from those small and medium-sized businesses and extending exactly the same technology to employees of businesses large and small.
I want to get into that because that's a fascinating angle. So in terms of the quantum raise from, and just for clarity for listeners out there, we're talking about equity capital. This isn't debt capital that you're using to fund the actual lending that you're doing to businesses. So equity capital. You talked about expanding to those large new markets quickly. I mean, is that simply setting up an office, hiring some people, getting any, regulatory licenses that are required, or is it entry through acquisition? How do you expect that $1.75 billion to be spent?
Great question. So it's all of the above. So equity capital is what we're using to develop and grow our businesses. Obviously, we're accessing debt capital from institutional investors and from funds and other banks to invest in the assets that we're generating with our clients, in the normal course of business. But we're using our equity to go and build those franchises in the countries that I mentioned. Each country is different. So each country has different regulatory requirements, licensing requirements, and so on. Give you an example, we've hired a really significant team now in India to go and build that business out. You probably won't see it actually in the market for the best part of 6 months because there's a whole load of work with the RBI and other regulatory bodies in India to get the licenses in place so that when we launch, we're ready to go from day one, at speed and at scale. Equally, if you come across to the other end of the spectrum, the B2C opportunity that we touched on, we've just made an acquisition, a company called FreeUp, recently been in the press. You'll see us, without sort of front running, you'll see us growing through a combination of organic and acquisition opportunity over time. I don't think you'll see any transformational acquisition because we frankly believe in our ability to build our business better than paying away for somebody else's. But we're not averse to building and bolting on product capability. A good example of that would be Finacity, which is the largest non-bank provider of receivable securitization globally, which we acquired 4 months back now. And we're very, very focused on integrating, given the synergies between our core business and the securitization proposition that Finacity offer. So I think it's going to be a mix of all of those things. The biggest challenge, quite frankly, is prioritization. There's so much we can be doing in the 6 months I've been here. It feels sort of more like 6 years in a very good way. There's just so much going on.
I'd love to talk a bit more about that B2C proposition. There are a handful of companies, maybe some of the earlier examples coming out of the U.S. A company called Earnin comes to mind around effectively unlocking daily earnings, either for gig workers or I think even to an extent employees. I think some of those companies operate on kind of a tip model. So you don't pay interest per se if you're the employee. You decide to tip the service. So maybe you pay $1 for whatever, $200 received early, which some people get up in arms about because from an APR perspective, it's astronomical. But similarly, it does seem much better than falling into some sort of payday lending debt trap. You guys, it sounds like, are taking a different approach to that problem and are potentially well positioned to solve it at scale.
I think that's right. We're not first to market in terms of the concept of allowing employees to get paid when they actually provide the service, i.e. their day's labor. And if you think about it, we're all employees and we're all extending payment terms by 30 days to our employer. So the proposition is, if I've delivered the service today, why can't I get paid today? And if the benefit of doing that means I don't have to take a credit card at an egregious APR, it means I don't have to take a payday loan at an even more egregious APR, then that's got to be a good thing. So then the question becomes, so what do I have to pay as an employee? And you're quite right. I think there are a number of small players in the US, and there are one or two small players in the UK as well, who are providing this service today, but you are having to pay £1, £2, $1, $2, whatever it is, to utilize that service. And if you convert that into an interest rate, because on average over the course of a month, you're probably taking 2 weeks worth of credit, that actually can compare with the sort of credit card APRs and payday loans that I think we're all working in good faith to move beyond and eliminate payday poverty. Fundamental to our proposition is that the employee should not be paying anything, period. In terms of the public sector, our view is that this is something that we can actually do to contribute and recognise the value of public sector in the UK and elsewhere, and that there shouldn't be an economic model built around this. So if you're a nurse, for example, in the NHS, in our view, you should be able to go and get paid the same day, rather than have to worry about whether it's opportune to work for an agency because you get paid after 1 week as opposed to working for the NHS where you get paid after 1 month. Those are the sort of things that we want to take off the table. I think the principle is sort of well understood, because if you can do that, you create more motivated workers who are better focused on the work, and actually the retention rates for the employer go through the roof as well, because you become an employer of choice. So I think there's huge benefits to employees and employers of doing this. The economic model, though, to come back to your point, for us, we are absolutely categoric, and employees should not be paying for this. So in the context of the public sector, we think that's something which we can actually contribute back to society. And it's quite nice, actually, I have to say, without getting too mushy about this, to work for a financial institution where you can hold your head up and say, I'm really proud to be doing this. In terms of the corporate market, and we're sort of moving towards that as well. We're piloting, by the way, right now. We'll be rolling this out in Q1 of next year. Our view is actually, what are we doing? We're taking exactly the same principles as supply chain finance. We're taking credit risk on the corporate. And what sort of period of time are we taking that credit risk for? Well, it's over the period of a month. So again, on average, probably 2 weeks. So the cost of capital for that corporate, and for us, given we're having to fund it in, for that period of time, is really a proxy of 14-day commercial paper for the corporate in question. We're talking, probably single-digit basis points, certainly hugely cheaper than any employee would be able to effectively go out and finance themselves for in that period of time. How are we able to do that? Well, actually, again, same technology that we've applied for supply chain finance, i.e., at the end of the month, the employer will pay the proportion of the salary that the employee has drawn directly to us. So as long as the employer, the corporate, is a going concern at the end of the month, we get paid at that point in time. We're not taking consumer risk in the process, but what we are able to do is provide access to capital and access to the money that employees have earned on the day that they've earned it as a result of that.
Yeah. I mean, it's brilliant because it seems on one level so simple when you describe it in those terms. You're the first that I've ever come across to have hit on it and be pursuing it in the market. I think especially around the public sector piece that you were mentioning, right? We're talking about critical infrastructure when it comes to hospitals, when it comes to police forces, when it comes to public school teachers.
Right.
And I think you were citing some research before we started recording about how a significant portion, maybe as many as half, of NHS nurses would prefer to leave their direct employ with their hospital, join an agency at a rate that gets charged back to the hospital, presumably higher than what they were on when they were employed directly, simply because they get paid weekly instead of monthly. So there's a massive burden on the public sector, on the hospital system in that case, simply to help support the nurses in this case meet their day-to-day, week-to-week financial obligations. So a product like this at scale is just massively transformational, especially if you think about it in the context of the research around financial stress and the implications on health, performance at work. You're talking about significant, broader economic impacts here.
Absolutely. I think what it does, without getting into the specifics of third-party research and analysis, because we haven't carried out that research ourselves, but I take your point absolutely. What this allows us to do is remove a whole load of frictional cost and align people on what's really important, i.e., in the case of a nurse, being able to focus on their job, right? I mean, what's more important than for all of us than a nurse focusing on their job rather than worrying about how they're going to settle a credit card bill at the end of the month. So yeah, I think genuinely it's transformational. It also has, and I put slightly my banker's hat back on when I say this, but it has a real economic boost as well, because it's bringing forward, if you think about it, the injection of money into the system at the end of a month on a real-time basis. So it's accelerating cash coming into the economy and therefore accelerating potentially by creating a short-term boost to GDP. So when I look at this, and this is one of the things that is tremendous actually to be working for a company like Greensill, because there's always something new that people are thinking about and creating. My view is that this has enormous potential, actually, and it's only a personal view, but actually potential to be bigger than our core business. I mean, let's see, our core business is growing at 100% year on year, as I said, but I just think this potentially is transformational in a much larger social context on a global basis.
Yeah. And it feels like a greenfield opportunity. So presumably you're extremely well positioned. I'd love to wrap up, talk a little bit about how Greensill in your own personal experience is different from traditional players in this market. So maybe real quick background on you, because I think you've held some very senior positions at banks throughout your career. Can you give people a bit of a bio for reference?
Sure, very happy to. So I spent most of my career actually at Citigroup, which is where Lex and I met sort of 9-10 years ago, and along with a whole lot of other members of the Greensill family. I moved from Citi to run a family office for a high net worth Indian, which was a great experience, a real opportunity to sort of see an entrepreneurial environment firsthand, the highs and the lows on a daily basis. I mentioned, I think, that I was helping Lex and the guys who were setting up Greensill at the time. I was allowed to do a couple of non-exec type roles, and this was one of them. The other actually was helping Lex, who was an advisor to the UK government at the time, and we were looking at how, for example, you can apply, again, the same concepts of supply chain finance to, for example, pharmacies who are waiting 30 days to get paid by the NHS. Well, that's government risk. But if you have to wait 30 days, you've got to go to Lloyds or Barclays or HSBC and borrow at 6%. So we were working on that program, and actually that program is now well established and still in place and has grown significantly. We run that for the UK government. In fact, we're the supply chain finance partner for the UK government today. But sort of back to answering your question. So I, having spent a few years at the family office, which I very much enjoyed, was asked by Standard Chartered to come and run corporate banking for them in the UK and Europe. And it wasn't that I was looking for the opportunity to go back to a big bank and the 10,000 committees and all of the bureaucracy. But actually, I saw in that particular institution an organization which was in some interesting markets, had a brand which clients trusted, but certainly in the UK and Europe was not punching its weight. So it was an opportunity to go back and help restructure and build a franchise. And that's something that I've always been interested in throughout my career. I took a view that that was time bound, and I should be able to do that within 3, 4, 5 years, which I did. And I always had the intention, and Lex and I'd kept in close touch. And I'd said, just give me 5 years, Lex. Let me, I need to demonstrate to my wife now that Greensill, has reached a point post private equity funding that it's credible, and it's a sort of stable environment, even though it's a fast growing one. And fortunately, General Atlantic and Softbank allowed me to persuade Mrs. Hanafin that this was the right thing to do. So that's the path that brought me back to Greensill.
Okay, so as former head of corporate banking, UK and Europe for Standard Chartered, now president of a SoftBank-backed fintech. I mean, firstly, it's tough to imagine two more different worlds. What is it about Greensill in your mind, if anything, that makes it fundamentally different from the way that traditional banking has worked, the traditional supply chain finance has worked? I mean, is this just, people start designing from a blank sheet of paper and raise similar money as a big bank would have raised, and I don't know, they're just a bit more efficient, or is there something fundamentally different?
It's a great question, actually, and you're quite right. I mean, the two roles I had and now have are very different in terms of context. What's really important, I think, though, as Greensill has grown up, is that we apply the right standards of governance, of risk management, decision making, of structuring the organization in a way that it can become, a significant and a scaled business, as clearly Standard Chartered and Citi and all the other banks that we now compete against are, but in a way which doesn't stifle innovation. And I'm not, by the way, suggesting that innovation is stifled in any deliberate way in a large bank, but the construct is such, and the incentivization is such that you're very short-term focused. If you want to do something and sort of change the way a bank offers a service to a client, it will take you probably years rather than months to do it. And it becomes, frankly, just too many brick walls to bash your head against before you give up and work out that actually you're not going to make budget this year if you spend all your time trying to innovate a product. You should be able to do both, in my view. And if we set the organization as we are, I believe, on the right track, we create enough scope for innovation and creative thinking on the one hand, but put in place the right frameworks around governance and so forth on the other, so that we can grow and scale in a safe way, but in a way which doesn't stifle the innovation, which frankly is the lifeblood, I think, of any successful business. So I'm not sure whether that answers your question, but I think it's about taking the best of what I've seen and what I've experienced in large banks and applying it to Greensill and making sure we don't bring across some of the other things which slow things down. Excellent.
Well, Sean, congratulations to you and the team on the past 8 years of what sounds like very effective work, and look forward to watching you guys succeed going forward. Sean Hanafin, thank you very much for joining us today.
Thanks, Will.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.